Hi, and welcome to Module 4, Part 1, Equity Financing. So the lecture includes two main parts. In the first part, we look at equity valuation models. So we're basically using the perpetuity formula, variations of the perpetuity formula to price equity. So that's what we call a dividend discount model. We then look at different types of equity issues and different ways that company raise equity financing. The learning objectives for this lecture includes firstly looking at the characteristics of ordinary shares. We then talk about a dividend discount model. Dividend growth model is one of the type of the dividend discount model. We then look at bonus issues and share splits, rights issues, private placements, discount, dividend reinvestment plans. So all these are different alternatives to raise equity financing. We then look at internal funds as a source of finance. So internal funds is like retained earnings. So they basically equity financing, but they are internally generated fund. We look at hybrids, mostly preference shares and convertible notes. We then look at, we then evaluate the advantages and disadvantages of equity as a source of finance. And we look at private equity. Then finally, we look at the process of an initial public offering. So how does equity financing fit into the overall capital market? So we mentioned before that with corporate finance, what we worry about is we worry about equity financing and debt financing as the two major sources of finance, right? So with equity financing or debt financing, we're basically trading between present values and future values, right? So we're trading off current consumption for future growth. The key participants in capital markets are the surplus units being either equity investors or lenders, and the deficit units being the company that issue the equity or the company that borrows from the bank. Right. We then have financial intermediary standing in between the surplus unit and the deficit unit. So we could think about different ways of raising equity as firstly the types of the equity issue. So we could have initial public offerings and seasonal equity offerings. So with the initial public offering, this is the first time that the company is listed in a public exchange. Seasonal equity offerings refer to any subsequent share issuances in the market. Private placements of equity. So sometimes firms can choose to issue equity or raise equity financing from a group of investors, not in the public share market. So the advantage of the private placement method is that it's cheaper compared to the public issues. But the downside is that you have limits on how much you can issue to a group of investors. So there's a dilution issue here, and therefore you cannot issue too much equity to one or a group of investors. Dividend reinvestment plans. So these are not actual issuances into the market. These are the plans that the company offer to existing shareholders, whereby they don't have to pay dividends. They get to keep the cash, and the investors get to increase their shareholdings. Rights issues is more or less like an option. So the existing shareholders have an option to buy new shares at a discount. So it gives the existing shareholders an incentive to buy new shares in the company. We could also think about equity issuances as being internally generated or externally issued. Right. So internal financial market is something like cash flows, like the firm's own cash flows. Right. So when the firm generates cash flows, they might decide to either pay the cash in dividends to shareholders, or they might retain the earnings for future investments. So retained earnings are internal funds. So in this way, the firm save issuance costs, so on and so forth. External financial markets. So this is when we go out and issue shares into the public market or to the private market, private investors, right? So this is not from the firm's own cash flows. This is from outside investors. Okay. So the benefits of internally generated equity is that it's relatively cheap. You don't have to issue shares, so no issuance costs, less time consuming, more discretion to the managers, so this can be good or bad, depending on whether the manager is good or bad. No need to disclose information, so no worry about competitors getting private information, right? External financing, on the other hand, allows companies to raise a large amount of funds, but at the same time, you have to pay all the issuance costs, and you have to prepare prospectus, which means that you have to disclose information to the market. Different types of firms tend to prefer to use different sources of financing. So normally we find that firms that have more intangible assets, like tech firms. So with tech firms, most of their assets are from patents, right? So from innovations. So these assets are intangible, and therefore it's harder for these firms to borrow from like banks, for example. So as a result, we see that these firms hold a lot of cash in their book, so that in the future, when they have to invest, they can use their own cash, right? On the other hand, we have mature firms issuing bonds into the public markets, right? So these firms don't typically use equity financing because they have access to the bond market. We then look at different valuation models for common equity and preferred equity. So with common equity, these are residual claims, right? So common shareholders' claims of the firm's asset is residual in the sense that the debt holders get paid first, the preference shares holders get paid after the debt holders, and whatever is left to the common shareholders, right? So for common shares, we have three types. We have a no-grow in dividend model, where we assume that this is say like a very mature firm. For example, Telstra, in the past, they have paid fixed dollar amounts of dividend every year. So for this model, when we have no growth in dividends, we can just simply use a normal perpetuity model to price the common share. We then have a constant growth model, where we assume that the cash dividend grows at a certain rate every year into perpetuity. We then have a non-constant growth model, where we try to model a firm, it's like a young firm, where in the first few years the growth rate can be variable. Then after the first few years, the firm stabilizes and the growth becomes constant. Right. So in the non-constant growth model, we have two parts. The first part being the non-constant growth component, the second part being the constant growth component into perpetuity. With preference shares, because normally for preference shares the dividends are fixed, so we tend to use the no growth in dividend model to price preference shares. So it's more or less more simple than common shares. Note that for preference shares, the terms of the preference shares tend to be more complex, but here which is pricing the cash dividends for preference shares. So we ignore all the options of preference shares, and that's why the pricing model for preference shares is more simple than common shares. So the assumptions of equity valuation model include, firstly, that we assume that the firm never goes bankrupt, so that the cash flows go into perpetuity, right? And second, using the dividend discount model, we need to assume that the dividend payment and growth are fairly stable and predictable, right? So that we can use the constant growth model or the no growth model to price the shares. Our next assumption is that the price of a company's share is the present value of all of its future dividends, right? So in other words, what we're doing here is we're just doing a present value calculation of all the future dividend payments, right? And because we assume that the dividends go into perpetuity, we use the perpetuity model to price equity. So with ordinary shares, as we mentioned before, ordinary share has voting right, and it's a residual claim in the sense that ordinary shareholders get paid last, right? After the suppliers, after the tax payments, after wages, after debt holders, and after the preference shareholders as well. So the returns of a common shares investment could be broken down into two components. We have the dividend yield and we have the capital gain, right? So the return from a share investment has two components. Dividend yield is calculated by the cash dividend divided by the purchase price or the value of our investment, right? The capital gain is calculated as the difference between the sale price and the purchase price divided by the purchase price, right? So this is the dollar gain divided by the initial investment. So if we think about a share price, the current share price, as being the present value of all of the sum of the dividend payments in the future. Right, so in this formula, as we notice, we don't have the capital gain component here, we only have dividends here. It doesn't mean that we ignore the capital gains part. This just means that the future price that we sell the share at, or the sale price when we exit the investment, would have incorporated all the future dividend payments beyond time end, which is the time that we sell the share already. So to illustrate the point that we mentioned before, we could express the equation from the previous slide using this equation. So we still have the present value of the share, but this time we express it as being the sum of all the dividend payments that we get from time 1 to time end, which is the time that we sell the shares, and the present value of the sale price at time end, right? So this present value here, sorry, not present value, but the price that we sell the share at time end is simply just the present value or the value at time end of all the future dividend payment, right? So overall, the calculation here is simply just the same as before, where we have the present value of all the future dividend payments, right? So this is simply just the value of the future dividend payments beyond time end, discounted back to time 0. So for example, we have a company where we know the the dividend payment is 50 cents per share, and they pay 2 payments a year, right? So this is a semi-annual dividend payment. We expect to sell the share at $12 in 1 year's time. The required rate of return is 5%. So the question is, how much are you willing to pay for the share today, maximum, right? So the idea is, we have ownership to these cash flows in the future. Therefore, the maximum price that we want to pay for these shares is the present value of all the future cash flows, right? So using the formula that we saw before, the price of this share is simply just the sum of the present values of all the cash flows that we get in the future, right? So here we have two dividend payments. One happened in 6 months' time, and one happens at the end of the year. We then have the share price. We have the sale price of the share at the end of the year as well. So what we're doing here is we're simply doing a present value calculation, discounting all the cash flows back to time zero. Right. So in the next few slides, we'll be looking at 3 different types of dividend discount models. In the first model, we have a constant dividend model. So with this model, we assume that the dividend payments are fixed from one dividend to the next, and therefore we simply are just using the perpetuity formula to price the common share, right? So the price is simply just the cash flow divided by the cost of capital, right? The cash flow here being the dividend payments. So for example, here we have a firm that pays 30 cents per dividend, and the discount rate is 7% per year. The price, therefore, is simply just 35 cents divided by 0.07, so that's $5. Now, so if we can't assume that a firm is paying a fixed dividend forever, then what else could we do to price the share? We could use a constant growing dividends model, where we assume that there is a growth component and the dividend is growing at a constant rate. Right, so it's very important that we have a constant growth rate. So with a constant growth rate, this is how the dividend payments look like. Suppose that this is my timeline. So this is year 0. So yesterday I just got paid a dividend of D0. Say D0 is $1, right? In year 1, the dividend grows at G%, and therefore the dividend in year 1 becomes D0 times 1 plus G, right? Similarly, in year 2, for year 2, from year 1 to year 2, the dividend grows again at G%. So in year 1, our dividend is D0 times 1 plus G. Therefore, in year 2, the dividend payment, the dollar dividend, is the dividend in year 1, which is D0 times 1 plus G, times 1 plus G again. Right. So we have D0 times 1 plus G squared, so on and so forth. Right. So this model could be expressed using this equation here, where we have the price of the share is equal to the dividend at today's time, the dividend that we just get paid, times 1 plus G, divided by the cost of capital minus the growth rate. Or we could express that in terms of the dividend that we get paid next year. So the price is equal to the dividend that we get paid next year, divided by the cost of capital minus the growth rate. So it's very important here, when we read the question, to try to work out whether the dividend is the dividend in year 0 or the dividend in year 1. So going back to our example before, we still have the same dividend payment. We have the same cost of capital, but in this case, we're assuming that there is a growth component for the dividend, which is 5%, right? So using the formula that we saw before in the previous slide, we work out that the price of this company now becomes $18.38, right? So it's a little bit higher than before, reflecting that the cash flows, we get bigger cash flows as time goes by, right? Next, in the variable growth dividend model, so what we have here is that we have 2 components of the model. In the first component, we have variable growth rates, right? So from year 1 to year K, the growth rates in these years can be different. So in the first few years of the firm's life cycle, when they go through a period of strong growth, this would be like say normally for 5 years, 5 to 7 years. So in the first few years, we could have a different growth rate compared to in the last, not in the last, but the remaining years of the firm's life. We assume that the growth rate becomes stable. Right. So in the first few years, what we do here is that we're just simply discounting individual cash flows, individual dividend payments back to time zero. And in the remaining years, when we assume that the dividend growth rates become stable and become G, then we can use a dividend with constant growth model to price the rest of the dividends. Right. So this is basically a deferred perpetuity with a growth component. So for example, we have this company here. If we draw a timeline, this is what it looks like. So in year 0, we get paid 90 cents in dividend. From year 1 to year 3, the growth rate is 15%. So this is the period of high growth. Then starting from year 4 onwards, the growth rate becomes 6%. Right. So this is a company with non-constant growth in the first 3 years. Therefore, for the first 3 cash flows in year 1 to year 3, we gotta discount the cash flows back individually. Right. From year 4 onwards is a perpetuity with constant growth model. So we have a deferred perpetuity here, starting from year 4. Right. So the last component of the formula is just the present value of a deferred perpetuity with constant growth. So the dividend in year 1 is simply just the dividend in year 0 times 1 plus 15%. Similarly, from year 1 to year 2, our growth rate is again 15%. So the dividend in year 2 is just D0 times 1 plus 15% square. In year 3, D0 times 1 plus 15% to the power of 3. Right? So we discount all these 3 back. The dividend in year 4 is the dividend in year 3 grow by 6%, right? So the dividend in year 3 is calculated before, which is this component over here. Therefore, the dividend in year 4 is simply just D3, or this part over here, times 1 plus 6%, right? So the perpetuity, this part here is the pricing formula for a perpetuity with constant growth, and the first component here is simply just discounting it back to time 0. Okay. So substituting the number into the formula, we get a price of $11.75. Right. Alright, so in the previous examples, we know the dividend growth rate. We assume that we know the dividend growth rate. In the next few slides, we'll look at a case where we don't know the dividend growth rate, right? So what we're doing here is we're working out the dividend growth rate from earnings, yeah? So here we're assuming that all the dividend payout is from earnings. So when the firm makes profit, say this is $100 for example, they could either choose to distribute the cash flows to shareholders as dividends, or they could choose to retain the earnings, right, for future investments. As a result, the total earnings would be the sum of dividend payments plus the retained earnings. Also, the dividend per share is just the earnings per share times the dividend payout ratio, right? So it's the same idea as here. So if we assume that the number of shares is unchanged and the dividend payout ratio is unchanged, the increase in the dividend payment would therefore have to come from earnings, right? As a result, we could assume that dividend growth is equal to the earnings growth. So to estimate the dividend growth, we could use the earnings growth as our estimate, right? So the next question is, how do we estimate earnings growth? So assuming that all future earnings growth is from new investment, so the extra dollar in earnings comes from the profitability of our investment. Also, we mentioned before that when a firm makes profits, they could choose to either pay dividends or they could retain the earnings for future investment, and therefore the maximum amount of investment that we can make is how much we earn times how much we want to save out of the earnings, right? So starting with the earnings growth equation, so earnings growth is simply just the change in earnings divided by the total earnings, right? So given that change in earnings is equal to new investment times the return on investment, we substitute the change in earnings by new investment times the returns on investment. Also, given that the new investment amount is equal to the product of earnings times the retention rate, then we have this equation over here, right? So earnings times retention rate times return on investment divided by earnings, right? So these two terms cancel each other out. We have earnings growth being the product of the retention rate times the return on investment. So a note about the retention rate here. So we know that 100% of earnings have to be either paid in dividends or keep as retained earnings. Therefore, the retention rate is simply just 1 minus the dividend payout rate, right? Okay. So given that dividend growth is equal to earnings growth, and from the previous slide we work out that the earnings growth is retention rate times returns on investment, we therefore have dividend growth equals to retention rate times the return on investment. So we talk about the dividend discount models as one way to price equity. The shortfalls of this model include, firstly, if we have a firm with no dividends, then we can't really discount cash flows, right? We have no cash flows to discount. Second, if we have unstable dividend forecasts, then our estimate is not very correct. Other approaches to valuation includes, firstly, the discounted free cash flows method. So instead of looking at dividends, we could do a free cash flow analysis where we estimate futures cash flow from the firm and we discount the expected cash flows back. We could also look at asset values and compare that with other peers. We could also use multiples, so we compare the different ratios of the firm with their peers, and using these ratios we work out the relative value of the firm compared to peers of different sizes. So when we think about common equity as a source of finance, the advantage of common equity is that because it's a residual claim, the dividend payouts are not fixed from a company's perspective, right? So it's not an obligation for the firm. We have no maturity date, meaning that we don't have to worry about the principal paying back the principal to the shareholders. And there's no default risk from a firm's perspective. So the shareholders can't, in theory, can't bring the firm to court because they failed to pay dividends, right? Disadvantages. So firstly, from an existing shareholder's point of view, when the firm issue additional shares, their ownership in the firm is diluted, right? So you have a new person coming in and they share the ownership. They affect the decisions that you can influence in general meetings, right? In firms meeting. in some countries, dividend incomes are taxed twice. So in the classical tax system, the firm's profits get taxed once at the firm's corporate tax rate. Then when the dividend income is paid to shareholders, they get taxed again. So sometimes it's not as good as capital gains because they get taxed more. Transaction costs. So when the firm issues shares in the market, they've got to pay issuance costs to investment banks, so on and so forth. Signaling is, so normally in the data we find that when a firm issue equity, the markets tend to react negatively, right? That's because the market believe that managers only issue shares when they believe that the shares in their firm are overvalued, right? So that sends a bad signal to the market and it depresses the share price. We then talk about preference shares. So unlike common shares where you have 100% ownership proportional to how much you invest in the firm, preference shares have less ownership, but their dividend payout is more or less fixed, right? So you can have cumulative dividend payouts where if the firm skip dividend payout in the period, they got to pay back to the preference shareholders in the next period. Okay. So we mentioned before about preference shares being cumulative or non-cumulative. So when the preference share is cumulative, the firm has to make the dividend payment in the next period if they skip a certain period. Redeemable shares is quite similar to debt where they have a fixed maturity. We also have other features of preference shares, for example, participating or non-participating. So this is about whether the preference shareholders are entitled to additional profits beyond what's in the contract or not. Convertible or non-convertible. So after a certain date, the preference shares could be converted to ordinary shares with full voting rights. In terms of the classification as debt or equity, it's a because it's a hybrid. It has the features of both debt and equity, but for tax purposes, sometimes it's necessary to classify them either as debt or equity. So with preference shares, the advantages of preference shares from a company's point of view relative to ordinary shares and debt is that firstly, it's non-voting, so it cannot dilute the current power of the ordinary shareholders. Also, preference shareholders, even though for cumulative shareholders, they have the right to get the dividend payments in the next period if the company skips the dividend payment in the previous period, but they still cannot force the firm into liquidation. It's easier to value because normally they pay fixed dividends, but as I mentioned before, the cash dividends are easy to value, but the options in the preference shares is more complex to value compared to common shares. In this part, we're talking about different ways to raise equity capital. So we have public issues being either IPOs, the initial public offerings, or SEOs, the seasonal equity offering. So most of the time people are more interested in IPOs because the firm is listed for the first time. There's much more attention, much more interest, much more uncertainty, and therefore more opportunity for profits. We then talk about rights issues. So these are options for shareholders to participate in buying additional shares at cheaper prices. Private placements are just a normal issue, share issuance, but it's issued to just a selected group of investors. So there's issue about dilution of ownership here. Private equity is a special form of financing, normally for young and startup firms. Bonus issues and share splits are non-cash issues, so the firm doesn't get any more money right? Dividend reinvestment plans is when the firm is not actually issuing shares. Sorry, it's the firm is issuing shares, but to existing shareholders, so they get to keep the cash dividends, but they don't have to go through a formal process of a share issuance. Public and private ownership. So when the firm decides to go through an IPO, or it decides to float on the public exchange, then that's when the firm goes into becoming a public firm, right? So going public means that the firm's original owner lose some sort of control. So depending on how much share they sell into the public market, they lose a bit of control of the firm. They've got to disclose information subject to the requirements of the exchange. They have to pay listing fees, and they have to meet certain requirements set by the exchange before they can go public. So we talked about IPOs and SEOs before. They are both share issues, but IPOs are just the first time issues, and SEOs are subsequent issues. So when the firm wants to go public, they go through an IPO process where they issue shares for the first time. To be able to issue an IPO, the firm has to meet certain requirements from the stock exchanges. So they have to be large enough. They have to have a certain corporate governance structure. They have to appoint underwriters for the issue. So these are the professional, normally investment bankers, that help with the pricing of the shares, issuing prospectus, so on and so forth. They have to disclose information to the public so that investors know how to price the share correctly. So they have to prepare a prospectus and disclose proper information. So initial public offerings can vary from time to time, and normally it's correlated with the business cycle. So when you have good business conditions, you have a lot of firms going through IPOs, and so on and so forth, right? So an explanation here is that when you have a very good business condition, normally the share markets tend to be overvalued at that time. So it's a good time for firms now to sell shares, right? So they get more capital out of it. As a result, we see a lot of share issuances, not just IPOs, during times when the stock prices are high. So with the IPOs, as we mentioned before, it's the first time the firm goes public, and therefore there's no historical information available to the public. So the issue here is, how do we value this firm correctly given the lack of information? Right? So going through the IPO process, the firm could choose two pricing methods. They could either fix the price and offer a fixed price to all investors, or they could do a book building process where the investment banker goes around and survey the demand of the shares from other institutions, right? So based on the quantity of demand, they would then calculate the price accordingly. So what do we mean by underwriting, right? So underwriting is a service provided by an investment bank or a stockbroker. The underwriter contracts to purchase all the shares that have not been bought by other investors at the closing day of the issue, right? So what investment bank does here is similar to an insurance firm, where they say that if the firm issues 100 shares, and if not all of the 100 shares are bought up, then an investment banker would go and buy up the unsubscribed amount, right? So if other investors buy 50 shares, then the investment banker has to buy the remaining 50 shares. For a book building process, there's no need to use underwriting services because we take into account the demand, the quantity of demand already when we do the book building. In selling a share issue, normally the investment banker, who's the person who underwrites the issue or who conducts the book building process, they will also serve as the distributor of the shares as well. So they sell the shares at the fee. Also, for IPO issues, we normally find that IPO tend to be underpriced, meaning that the shares offered in the IPO tend to be priced at a discount relative to the fair price of the company. Right? So, say for example, Facebook, when they got listed, they might be priced at $10 per share, but in the IPO, each share is sold at $8. Right? So the question here is why? Why do firms decide to underprice their shares? This graph here shows the percentage of underpricing across different countries. Right? Accordingly, in China, in India, and Malaysia, the underpricing amount is quite large. Right? So why is that the case? So for underpricing, because we're dealing with firms with no historical data, historical information to correctly price the firm, so there is a degree of uncertainty for investors in the IPO market, right? Normally institutional investors. So to compensate investors for the uncertainty, firms tend to choose to underprice the security to make sure that so it acts as a risk premium for the investors. Right. Second, the more they underprice the shares, the less likely that the investors would make loss when they sell the shares in the secondary financial markets. Therefore, it creates confidence in the investors, and for subsequent share issuances, they are more likely to buy up the shares of the same company. Also, as we mentioned before, because the firm going through an IPO has a lot of uncertainty, underpricing would help with liquidity because investors know that they are less likely to overpay, right, for the issue. Also, underpricing reduces the risk of being sued by investors if the firm is not underpriced and later on the share price drops in the secondary market. They might be sued for providing inaccurate information to shareholders. So in terms of floating a company, the costs are summarized as above. We have fees, we have issuance costs, so on and so forth. So that's the direct cost of issuance. We also have fees to underwriters and commissions. And we have underprice, being an additional cost of IPOs, right? So we have to sell our shares at a cheaper price. So for seasonal equity offerings, this is for firms that are already listed and they issue additional issuances after the IPO, right? So because it's already a public firm, there's less information asymmetry about the company, and therefore the underpricing issue is not present in subsequent equity issues. Rights issues is when a firm offers to existing shareholders that they could purchase additional shares in proportion to their current shareholdings at a discount. Right? So for example, if the investor has 5 shares in a certain company, they could buy 1 additional share under the rights issue at a discount. Renounceable versus non-renounceable. So for rights issues, it's an option for shareholders. So sometimes if shareholders don't want to take up the option, they could choose to sell the rights to other shareholders who want to increase their ownership in the firm. So this is when we have a renounceable shares issue, rights issue. a non-renounceable rights issue is when if the shareholders don't want to take up the rights issue, they can't sell their right, right? So there's no value in the option here. Subscription price is the price under the rights issue, and normally it's less than the market price. So it offers an incentive for existing shareholders to take up the shares under the rights. Ex-right day is the day on which the share begins trading ex-rights, so there's no rights attached to the shares in this case, and therefore we lose the value of the rights if we trade the shares after the ex-rights day. Comp rights is when shares are traded. When shares are traded comp right, the buyer is entitled to participate in the rights issue. So the shares that we buy include the rights in there as well. So to value a rights issue, so this is an option. So options have value, right? So to value the rights issue, we use this formula over here, where this is the value of the rights. N is the number of shares an investor must hold to have the right to purchase one new share, right? So it's important here that N is expressed as the number of shares that investor has to hold in the existing portfolio to have the right to purchase one new share, one more share, right? So if we have a 1 to 5 rights issue, then N is 5, yeah? So the investor has to hold 5 shares in order to buy 1 share under the rights. If we have a 2 to 5 rights issue, then what's N here, right? So in this case, 2 to 5 is similar to 1 to 2.5, right? So we want to work out how many shares we have to hold to be able to buy 1 share under the rights, right? So N in this case is 2.5, meaning that we have to hold 2.5 shares to be able to buy 1 share under the right. Yeah? S is the subscription price, meaning that this is the price under the rights issue. M is the current market price of the shares. Right? The value of the share after the rights issue, or the ex-right value, is given by this formula here. This is basically just the average price of the share, right? So do shareholders benefit from a rights issue? The short answer is no. So in theory, we're not increasing the cash flows of the firm, right? So the value of the firm is just the present value of the future cash flows. With the rights issue, we don't increase the value of the cash flows, and we don't even decrease the cost of capital, right? So the value of the firm in theory therefore shouldn't change, and the wealth of the shareholders therefore should not change as well following a rights issue. But this is only the case when we have 2 conditions that are met. So the first condition is that we have all shareholders taking up the rights issue so that the proportional ownership of each shareholder remains the same, right? Second, we don't have any new price-sensitive information accompanies the issue, right? So the market shouldn't react because we have no additional information besides that we are issuing the rights, right? Well, effects may occur if the above conditions are not observed. So, for example, if some shareholders don't take up the rights, then there will be a wealth transfer from shareholders that forego their rights to shareholders that take up the rights, right? Because of the ownership dilution. Private placement is similar to a rights issue. The only difference is that it's offered to a group of investors, not to everyone. Right? So compared to rights issue, private placements are cheaper, quicker. Investors are known to the managers. So normally managers will issue shares to friendly shareholders so that they don't run into the risk of being taken over. The issue here is that it's because it dilutes the ownership of other shareholders who are not participating As a result, the regulators place a limit on how much the company can issue shares in private placements, right? So the current limit is 15%. So with private equity, the idea here is that we're investing in shares or in equity that is not publicly listed, right? So we have two scenarios. We have venture capitalists whose strategy is normally to buy a young potential firms with a lot of growth potential. So what they do is that they try to help manage the firm and grow the firm to a certain size so that these firms can be publicly listed. So they would sell the firms into the public to earn profits later on. So their profit is the difference between the price that they bought the firm at or the equity investment they put into the firm and the share price that they sell at when the firm grows into a certain size and can be publicly listed. We have private buyout, where we have one or a group of investors wanting to privatize a public company. So they want to buy a public company and privatize it. We have dividend reinvestment plans. So this is when the firm, instead of going into the share market and issue equity, they want to avoid issuance costs, and therefore they offer to existing shareholders that they can retain the dividend payments and the shareholders get additional shares, right? So if the shareholders don't need regular cash, they can just keep the dividend in the firm, they get more shares. And also in Australia, with the imputation tax system, under the dividend reinvestment plans, the investors are still entitled to the imputation tax credits, even though they decide to keep the dividend in the firm. Other types of equity issues include bonus issues and stock splits. The only thing with these issues is that they are not meant to raise additional funds for the firm, right? So there's no exchange of capital from the shareholders to the firm. So with bonus issues, this is as the name suggests, this is a bonus to existing shareholders. So the existing shareholders are offered additional shares in proportion of their current ownership. Right, so the effect of a bonus issue is that it increases the number of shares and it reduces the price per share, right? So shareholders have more shares but nothing changes. So in theory, with bonus issues, there should not be any effect on shareholder wealth. We increase the number of shares, but at the same time, the share price decreases. Right? However, sometimes the market might react positively to bonus issues because they might interpret the bonus issues as providing positive information to the market. We didn't talk about share splits. This is when if the firm's share price is too high and managers think that the high prices prevent investors, some group of investors from trading the shares, then what they can do is that they can split the shares, right? So for example, our current share is traded. So for example, for a 4-to-1 split, if the current share is traded at 12, we want to split a share into 4. So from 1 share now, the investor would be owning 4 shares in the firm, but each of the share is only worth $3 now. Right? So in total, the value of the share portfolio of each investor should still be the same. So share splits similar to bonus issues are not expected to change the wealth of the shareholders from a dollar point of view, but it might improve the shareholders' portfolio overall because it improves the liquidity of the shares. Right? Internal funds. So this is when we talk about retained earnings. So we mentioned before that retained earnings are equity funding anyway because it belongs to the shareholders. The benefits of internal funds or retained earnings is that it does not affect the control of the company, so we don't change the ownership, the voting rights or anything, and we save transaction costs, right? The flip side of internal funds is that if the firm holds too much cash, and if they don't have new profitable investments, then sometimes it incentivizes managers to spend this cash unnecessarily. Right? So in that sense, it could reduce the shareholder value because of the managerial agency issue. So that concludes part 1 for module 4, where we look at different types of financing.